Perfect timing. All right. Good afternoon on the West Coast. Good evening on the East Coast. It is a truly incredible event that we have this evening. We have our All-Stars back for our annual Practice Transitions, the 10-year roadmap to properly protect the sale and value of your practice. This was certainly one of our largest events last year, and I think as a core component as a result, we were able to really help advise hundreds of doctors through the process of contemplating the next steps in their careers, let that be buying an additional location, looking towards some tax planning, right? And really, most importantly, helping to have a different perspective of the importance of being prepared. And being prepared, as Bill will share, usually 10 years prior to that transition, to help ensure that collectively there is a protective force field around those eventual practice sale proceeds. And also some great tips and tricks from the buyer's perspective as well. So on that note, let's jump in. We have a action-packed evening and a ton of great and additional content to really dig into from that perspective. First of all, our first VIP speaker joining us is Bill Henderson. Bill Henderson is a man with no introduction, senior transition consultant and broker at the Tier 3 Brokerage. Again, really interesting examples and stories, having seen it from the client side, right, with his wife selling his practice, etc., and having a very difficult experience selling that. Bill left, right, quite a successful career to then help to fix what was broken, which is to then buy Tier 3, a small two-person Ontario dental practice appraisal brokerage firm, right, and then grew that to be one of the largest, right, in a per capita basis in all of North America. Since then, now is a proud Henry Schein company, and truly you're in a lot of great, looking for a lot of great information from the one and only Bill Henderson. Bill, thanks for joining us, sir.
Thank you very much.
Look forward to a great one. I think we had some fantastic feedback from our one last year, and we're able to run a lot of co-calls together as well to help make sure that selling the practice, the lease, as well as tax planning really is one in the same vein.
Well, don't count on that same level of feedback this time. My wife and my children are not in attendance this time, but we'll get by.
Beautiful. With that being said, within the same vein, Andrea Chan, CPA and CA, Regional Managing Partner and member of the Insurance and Accounting firm at MNP. Andrea is one of the absolute best, is also one of the faculty members at the new mini MBA program at York, and looking forward to really sharing a lot of key components, especially now, as we were just talking, budget announcements coming through. Who knows? What is it? How do we help to be prepared? But most importantly, what do we know today, and how do we help to protect ourselves for the future? Andrea truly is incredible. We have dozens, if not hundreds, of mutual clients over the years. We're working one-on-one with the dental, medical, right, legal, other professions to help ensure that there's some good, sound advice, helping to look at a full 360-degree plan and help to ensure that you are able to minimize your tax exposure, which is truly the name of the game, especially as we look at the valuations of practices that have, quite frankly, never been higher. The income from, and taxable income or potential taxable income from a lot of these sales. We're into a great opportunity to have Andrea join us tonight. Andrea, thank you so much.
Thank you.
In the middle of tax season as well. All right, so let's jump in, shall we? So really, the purpose of today is those threefold. One is, how do we help to avoid the $100,000 mistakes that recently, there's even been examples of $160,000 mistakes, where the landlord specifically required a check from the seller purely in conjunction with assigning the lease from the seller to the buyer. It is, unfortunately, many landlords are catching on to the value of a dental practice, and also how important the lease is and termination rights, let it be through a demolition or a relocation or otherwise. So we'll touch on that. Part two then is how to prepare your practice for those transition components as we look at it from a tax perspective, and helping to sell your practice from the tier 3, looking at where the valuations fall today, how are the calculations done, and truly what is your practice worth. Then we also have some great pre-questions. So thank you to the dozens of you that had responded back to my individual email to you about some best advice for doctors looking to transition in 10 years versus 2 years from now, right? Thoughts on buying versus leasing spaces, especially as it pertains to the eventual sale of the clinic, and lots in terms of corporate dentistry. Right? What's the good, the bad, and the ugly as it pertains to the buyer, the seller, et cetera, and what are some things to do to ensure that you have as many potential buyers as possible to maximize that? And then also, certainly last but not least, is where do we see the future going? With that being said, again, a great reminder is the note section is open as well as the Q&A. And if it's on topic, we'll try to cover it as we go. If not, feel free to throw that into the Q&A or the notes. And we'll keep this as, again, interactive as possible so we can fly through. Lots of new information floating around. Let's jump in. For those of you that have not joined one of our webinars before, Cirrus Consulting Group, we're pretty unique. We're the only healthcare and dental specialized tenant representation firm of our kind in North America. This is it. This is all we do. 27 years in the business, now over 12,000, now over 13,000 successful lease negotiations. And we have the privilege of myself flying coast to coast to coast and really helping to really just scream from the rooftops of sharing to, especially to the dentist, how important it is to structure the right lease and how important it is to make sure that it's properly, not only from the financial components, but all of the business clauses are aligned to be dental specific and to be aligned with your long-term career goals. With that being said, data now is key, and everything is in flux. I mean, it's unbelievable. We started doing some of these in the crux as the global pandemic was starting. Now we've got wars in Europe and potential of dramatically increasing inflation and CPI rates. It is truly unprecedented times. With that being said, what is the data? Looking at national vacancies and market rent per square foot. So when we look at some of these trends, here's what we're seeing. First of all, now that we're coming through, we've seen a considerable amount of vacancies increase nationally from the beginning of the pandemic, obviously significantly increasing, right? And then also continue to increase. And we've envisioned, based on the data and the forecast, is that it will start to level off over time, but we've still got some increased vacancies as a lot of the retail tenants are simply getting out, and baby boomers are otherwise looking to transition. And therefore, that is creating a bit of a void for retail space, especially for dental practices. When looking at other components throughout the country and the provinces, here's a few examples from Brampton, London, Mississauga, Toronto, other components here across the province through my old hometown in Ottawa, Waterloo. So each location is sharing a different story. If you're interested as to what your specific rental rates and trends and or even some basic demographic information, at our bottom left there is info@cirrusconsultinggroup.com. We're happy to pull those and schedule a quick call to let you know what your specific market or building has been doing lately. So let's jump into some of the core components. One of the first here, as we look at it, just to get a sense of the room, right? Quick poll that's popped up. Tell us a little bit about your specific situation. As we're touching on, again, what is a lease and other components. Tell us a little bit about your situation. Are you currently planning to open or relocate the practice? Planning to acquire a practice? Planning to transition or sell the practice in the next 5 years? Or, you know what, Eric, I've seen the craziness that you never thought you'd see in the past 30 years of practicing dentistry. I plan just to hunker in, stay put, and renegotiate my lease and plan for ultimate transition. Or none of the above. Number two is what some of the goals of taking the course today. Number 3 is in terms of leverage with your landlord. When does your lease expire? And just because it's not up within the next 2 years, don't underestimate how important your lease can be to your eventual succession plan. And also some of the strategies, let it be expansions or in terms of relocating or even making some significant improvements or alterations in the space can all be leverage for you in your negotiation. In that also, if you plan to start or buy a practice, right? And then also many of you had already requested, but feel free to add through for those of you that are or have not had your lease professionally reviewed and you're contemplating or you have a digital copy now, and now that you're finally getting a breath after the craziness of the past 2 years with COVID, and now we're finally taking a breath and focusing on next steps. Happy to schedule that with you personally or with a member of the team. So looking forward, what is the lease? Right? As you're looking ahead of yourselves here, ultimately the lease represents the largest personal check to any single entity in your personal or professional careers. Where this becomes quite important is many of you that signed leases back in 2012 or 2002 or 1992 from that matter, right? It can represent a massive financial commitment. So we need to look at that differently. You need to look at your next renewal, not as a price per square foot, not as a $3,000, $4,000, $5,000, $6,000 a month, but quite frankly, what could be a multi-million-dollar commitment, not only for yourself, but also through the eyes of your buyer. Remember, for most of you, when that lease is being transferred from yourself to your buyer, they are picking up the good, the bad, and the ugly from your current lease and continuing on with that potentially for another 20, 30, 40 years, as you may have done yourself. So why are we talking about the lease? Why aren't we right into the valuation of the practice or right into how to minimize taxes? Why are we talking about the lease? Fundamentally, a few reasons. Number one is your location is your business. Your business is your location. And as you'll see from Bill, the practice without a set of keys is worth dramatically different than a practice which has a long-standing lease to ensure the continuity and predictability of revenue, right? Which ultimately is the cash flow that your buyer is saying, hey, if I'm about to pay Mr. Henderson 100, or $1.5 million for his practice, what's the likelihood that the patients are going to show up day one, right? And how much revenue can I anticipate if I can continue on doing what I need to do? That obviously is the lease. The lease either creates the rock solid concrete foundation to build the practice upon, or a crumbling shell that can cost tens or hundreds of thousands of dollars down the road. Number two is there are practices now being built out throughout the continent that is over $400 per square foot. That is ridiculous what some of the build out costs now some doctors are going through. So for those of you that haven't gone through a new build recently, it is shocking. So in comparison to doctors opening a brand new de novo, this, right, is an attractive component that either you're building it out yourself or buying a practice. You're paying for it one way or the other. But certainly the build out costs have skyrocketed, especially in key markets, especially with shortages and beyond. Very difficult and expensive, obviously, to pick up and move. We've seen some devastating examples. Personal client of mine, 74 years of age, tried to sell her practice 3 separate times. Each time the landlord found a reason to say no. Landlord wanted her space. Nice end cap, retail, neighborhood plaza. The landlord had a restaurant, wanted that space and said no. 3 separate times to 3 separate buyers. In the end, she hired us. We relocated the practice 10 minutes north. Luckily, we were able to get the landlord to cover the entire build-out costs through landlord work. But, right, can you imagine being at the end stage of your career and not being able to sell because of one little paragraph of black and white in terms of the assignment section of the lease? So that really comes down to what I discussed before, the putting a protective shell over the practice sale proceeds. Now, for many of you are saying and have said, Eric, good news, I own. Bill, I own my own building, right? I don't need to worry about the lease. Incorrect, right? Let it be if you own or you are selling. The question now is, or you're leasing rather, the question now is, do you plan to keep your building or your unit or your condo as a passive form of income into your retirement? If many of you said yes, then the lease can become very important. And no, it's not as easy as saying, well, let me wait until Bill lists my practice and find a buyer and then I'll create a lease. Then in many cases, it's too late. It is far more to your advantage, doctors, to be able to structure a lease now, years in advance, so that you have a very clear history of payments, let it be triple net or gross lease or otherwise. And that makes sure that the financials are crystal clear and that you've been paying yourself the same way that you want to be paid by your future tenant, your buyer. So it's important. It's difficult, right? You're wearing the coat every day and you're wearing the full-time landlord hat. What I ask you to do this evening as well is to look at it through the landlord hat as well, right? And as a full-time landlord hat. So let's look at two separate examples now. For those of you that are in the leasing situations, number one, these are the questions. Take a little screenshot, ladies and gentlemen. This is critically important and key questions that your practice transition consultant will be asking you as well, which is, when does your lease expire? Is there any options to renew? And options can be great for a buyer as long as they are transferable, or as long as you have properly exercised those before the option to renew deadline, which is an interesting strategy that many landlords do. They won't let you know before that has expired. Number three is, when do you plan to sell? Is it 5 years? Is it 2 years? Is it 10 years? That helps to strategically determine a course of action and what to share with a landlord and when. Less is more. Are the options transferable, as mentioned? I won't ask for a show of hands here, but again, through the questions, some of the things you can discuss are, and look as you're following along, is, are you personally liable? Have you given a personal guarantee, right? And if so, does that continue on indefinitely after you have sold in terms of continuing liability, which can state in your lease in the assignment section that notwithstanding anything to the contrary, right, or anything previously within the lease, after you sell, you still remain as committed as you are today. Doctors, that can be the equivalent of signing up a lease for your neighbor's kid's car and then moving out of province and retiring down in Florida, right? Yet still be just as on the hook as you are for the practice as it is today. Very important you're aware of what that is, and it's far easier to get removed or limited long before the sale than it is as soon as Bill has identified a buyer, we've got the letters of intent done, and at the last minute, okay, oh yeah, we got to assign the lease, right? It's far easier to get done now. So rate yourself, the state of your estate. Now, for those of you that own, same questions, right? But a little different. Who owns the building, right? Is it in your name personally or a corporation? Who owns your practice? Is it a personal or corporation? Andrew's going to touch on that as well. Are you paying yourself rent today? Right? How are you tracking those business expenses? Right? There's many of you that I've spoken to recently that have, one corporation, but that includes multiple real estate entities. That can include multiple different locations. These type of things, as Andrea will touch on, can certainly be missing out on some opportunities to have separate corporations from that perspective. In addition, right, is there a lease in place? Also, heaven forbid, if you were to pass away today, are you prepared for death? As a young father of 2 young kids under 5, these are questions that go through my mind all the time. So the more we can do today to help protect ourselves and our estate by making sure that if something happened to me, how do we make sure that there is a smooth continuity and that my spouse can be able to sell the business, right, or the practice, and move forward and have that as simply as possible. So the more we can do proactively, the better. So key components to be aware of within the lease. So for those of you with your highlighters out following along, this is another great component to screenshot here. Number one is the assignment. very important, that really dictates the if and how the practice is sellable and when, and as to what the process is. Number 2 is, does the landlord have the right to increase the rent upon the assignment? Or is there a consideration language? Is the landlord entitled to a percentage of your practice sale proceeds? And doing a team call with Bill's team the other day, there were multiple examples of his team that had doctors that, yes, the landlord wanted a payment in conjunction with the sale of the practice because they felt it was their location, not the blood, sweat, and tears of the doctor, right, that had impacted that was the value behind the practice. Number 4, for those of you thinking, oh my God, I just don't want to deal with any of this, I just want to walk away and give back the keys. It may not be that easy. Understand and be sure, is there any surrender, restoration language or similar that would require you to return that premises back to pre-dental conditions, which could be tens of thousands of dollars of demolition fees. I mentioned before, death and disability. This is something Cirrus got its reputation on back in 1994, is creating dental specific language that, heaven forbid, you were to suffer lower back pain, hand tremors, carpal tunnel, etc., or become incapacitated. Does that give you or your estate the ability to either renew the lease, not be held in default, or ideally a termination right? That you can send in that notice and be relieved of that ongoing liability. There's been devastating examples over the past few years, tragic. One doctor in his 40s who had built out a beautiful 6-operatory practice, 6 weeks prior to the grand opening had passed away due to a massive heart attack. Fully built out practice, no doctor, no patients. Ladies and gentlemen, how much is that practice worth? 0. In this case, less than 0. The landlord then wanted the spouse to be responsible for the roughly $9,000 a month, increasing at 4% per year for the remaining 9.5 years on the lease. The reason why we at Cirrus, as well as Andrea, Bill, and beyond, why we get passionate to do what we do and have conversations with each of you about your own specific situations is because if just some of the best practices or some of the heartache we've seen, we can prevent that from others by having professional representation, then we will continue to scream from the rooftops and do events just like this to ensure that you are now educated in terms of these components, and more importantly, how to help to prepare yourself for that. Because had that doctor had some professional representation, we could have added this type of language. The spouse could have given a termination notice within 3 months and walked away. So on that note, good news. We're going to go through each and every one of these clauses in detail. Bill, I know you love this one, right? Each and every one of these in detail. We're going to be here all night. Kidding. But for those of you that feel that, oh, my lease is just a standard form, Eric, and they'll never make any changes, these are just some of the clauses we look at and that we have negotiated over the past 12 to 13,000 times that, yes, do not fall into the trap of, well, hey, here's a standard form lease, sign here, doctor. We wouldn't have had the experience as we had if we just rolled over. It is so important the landlord is educated as to the unique needs of a dentist. So let's look at one practical example of a $100,000 mistake as it pertained to the sale of the practice. The assignment clause by definition really does talk about what is the process between two entities, the seller and the buyer, of the assignment, the literal transfer, the passing the ball from one to the other, right, from one practitioner to the other. So here's an example. Now, before I pass on to Andrea here, take a quick moment and scan through this quickly. This is found in 75% of dental leases. This specifically touches on the if and how and when and to what process a sale can occur through the assignment of that lease. So as Bill will touch on, one of the requirements of the transfer of the practice is typically conditional to financing as well as the assignment of the lease. Well, make sure you're aware of what is within this lease. Number one, that you cannot sell your practice without the landlord's prior written consent, full stop. The landlord wants to know who's coming in, and therefore, this language is in the vast majority of your leases for those on the line. Number two, The landlord shall have the option, this is very common, number one, to say, yes, I approve of Mr. Henderson. Number two, I do not approve of Mr. Henderson. Or number three, I will actually not only say no, but I will terminate your lease agreement on the effective date of your close of the sale of your practice. Can you imagine getting to the end degree with Bill and his team, and the landlord coming back at the 11th hour and saying, no deal, not only no, can you not sell, but I'm going to terminate and engage directly with the buyer. Also, be cautious of the fine print. In some cases, the landlord can have the right to revise the minimum rent, right, to the current market or 15% greater. What a great business to be in. And last, right, should the tenant receive any money, income, cash, goods, or any form of consideration, the landlord can be entitled to a percentage of those practice sale proceeds. Yes, money from your sale, the landlord can require and have required payment of one form or another as an adjustment on close or a direct payment to the landlord just purely for the assignment of the lease. And last but not least, if not most importantly, is when you want to sell, do you want it to be a clean break or do you still want to be on the hook? Be cautious with buyers engaging directly with your landlord. Because if there is a continuing liability clause such as this can, again, make sure that you and or your spouse and or yourselves personally remain personally guaranteed and liable. In terms of the continuing liability, it states you will not be released and will remain fully liable for any failure of the tenant or its assignees. One clause, right, potentially hundreds of thousands of dollars, and most importantly, the inability to sell the practice. We have a ton of great content here in the essence and appreciation of each of your time. One of the things that I will certainly share with you is that if there's even been an inkling of concern as to what is within your lease or what should be, or what are some strategies, would be happy to waive the fee for our lease review as a $1,995 value. Our team will spend time pulling the real estate report, scheduling a call, and talking specifically about your business. If you feel you've been working too much in your business rather than working on your business, this could be one of the most important conversations of your year. So from that perspective, again, we're here to assist. Let us know, and you can reach out to info@cirrusconsultinggroup.com, or there's a quick poll that we'll be able to add through there as well. As we pass on to Andrea, one quick question that's popped up as we toggle screens here is, one of the first is the fact you own your practice building advantageous when you sell? So I'll cover that from my side, and Andrea, we'll pass it over to you here. Ultimately, from a very high level, it can be. It can also be a bit of a hindrance, depending on what your plans are. If you plan to retain ownership of the building, that can certainly work to your advantage, but it can also cause a bit of strife or concern from the buyer's perspective. So it can be beneficial, but in many cases, some of your buyers will not be able to secure a loan to pay $1.5 million for the practice, pay you another $1 million for your building or your unit, on top of a $500,000 worth of student loan. So, right, it can be advantageous. It just depends on what your goals are, how it's structured, but you may be able to work out a great win-win-win. This might be a great multiple years of passive income through the negotiation of the lease for yourself. You remain the landlord, but giving the tenant, your buyer, a future option to buy, or a right of first refusal, or a right to purchase at a certain time or event. So it gives the value of the buyer to potentially be the building owner as well. So hopefully that answered that question as well. Again, feel free to add in any additional questions as we go. To the one and only Andrea Chen.
Awesome. Do you see my screen?
I do perfectly.
Okay, awesome. So thank you, Eric. As usual, that was a lot of fantastic information into leasing. And so I'm going to switch gears a little bit and focus my presentation on how to minimize tax on the practice sale. I know there's going to be quite a bit of information here, so the goal today is really just to pass on some high-level planning ideas over to you. So if you'd like to, like us to look into your situation in more detail, because obviously it needs to be tailored, we'd be happy to meet with you. You'll see on the poll on your screen there with some questions. So, feel free to respond to them specifically about whether or not you're incorporated, who you have as shareholders of your practice, if you are incorporated, what you actually have inside your corporation on top of the practice itself, because there's implications to that. And I'll try to tailor some of the presentation to your responses. So for the agenda, we'll start by reviewing why having a professional corporation is so powerful for tax planning. We'll walk through the difference between an asset sale and a share sale with some numerical examples so that you can see some of the tax savings that you can have by using the capital gains exemption. We'll also highlight some of the rules that you actually have to meet to try to use the capital gains exemption. And end off with what you can do in terms of tax planning prior to a sale. So in the poll, I think there's some of you who are definitely, still not incorporated. So, and that might be a good reason why. I mean, certainly incorporation isn't for everybody. Having said that, most dental professionals are incorporated, especially when they have a practice. And, the main reasons are that there's like a huge opportunity to defer tax on a regular basis. And it's over 40%, right, on an annual basis, because the top personal tax rate, as you know, is 53.5%. And the corporate tax rate on the first $500,000 of income in the corporation is only 12%. So the difference in tax rates really can be used to save more inside the corporation so that you can use that extra money to either pay down practice debt, buy equipment, buy another practice, or save for retirement. So you can potentially save taxes, on a regular basis, also through payments to family members if they're working at your practice at least 20 hours a week. So, a lot of times we have family members that are, working as office managers or, helping out on the floor, et cetera. So that's an opportunity there. But just be aware that there are new tax rules, not so new anymore because it's been a few years, but you want to make sure that you're talking to your accountant if you're thinking about paying family members through income splitting, so that you make sure you don't fall offside with some of the rules, because they can be, the penalty can be quite hefty. And then finally, if you are thinking about selling your practice, having a corporation can give you access to the capital gains exemption, which most of this presentation is going to focus on today. So if you're thinking about setting up a new professional corporation, or a PC as you call it, or re-looking at your PC setup, there are some important things that you should look at or be aware of. So first, if you currently own a practice and your practice is owned personally, you can't just set up a corporation and move your practice in there. The big issue is that CRA actually looks at you and your corporation as two completely separate entities. So if you were to just move your practice into the corporation, it's technically a sale. And I'm sure Bill's going to talk about shortly, practices are worth so much money now that, essentially if you're just going to transfer into the corporation, it's going to trigger a ton of taxes. And that's not a good thing. So to prevent that from happening, there is actually a tax election that you can file for to transfer your practice into the corporation. And it's only effective if you do it properly. So, you usually get the help of an accountant and a lawyer to essentially, put that together for you so you can make sure that is done tax-free. And as a side note, that it can trigger HST on some of those assets, so just be careful. And again, really, really important to do this properly and file the forms on time and correctly, because penalties do kick in if the form is filed late. So if you look back, and I suggest that you do, and realize that you didn't file this form when you did incorporate and you just transfer your practice in there, please make sure you speak to an accountant and they can help you, or we can help you complete it, even if it's late, because the reality is the potential tax liability on not filing this form is going to be so much higher than the penalties on the late filing. So I mean, I'd love to say that we never see this, but unfortunately, we see this pretty often. And that's why whenever we take on new clients, we always ask for a copy of the rollover form, because it's a pretty common mistake, particularly for practices that have been around for a while. So once you've transferred, in the practice on a tax-free basis, you'll also want to think about who you want as shareholders of your corporation. So remember, in Ontario, only the dentist, spouse, kids, and parents can be shareholders. So to the extent that your goal is to maximize the number of capital gains exemptions, you'll need to consider who you actually want as a participating shareholder of the corporation, which essentially means that the shareholder owns a portion of whatever is inside your PC, right? Which includes the practice and any savings inside. So when you sell the practice, and you're selling the shares of the PC specifically, whatever funds you get from the sale, each shareholder that's a participating shareholder is entitled and should receive the proceeds of the sale, or their portion of the proceeds. So, and with that, they will report their proportionate share of the gain on their tax return, hopefully get it sheltered and minimize the taxes that way. If we use a numerical example, if you sold a $2 million practice and you had yourself, your spouse, and 2 kids, each owning a quarter of the value, each of you should be getting $500,000 to be deposited into your individual bank accounts, right? So you can see that because the cash is actually going to the individual shareholders practically, when we're talking about the structure with some of our clients, there might be some members of your family that you want to leave out of the share structure simply because you're not comfortable with giving them that much money. And that's totally okay. That's a normal thing to think about, and you should think about the practical side of giving the money to somebody. And again, worthwhile to have a conversation, before you set up your corporation or as you reevaluate your structure, as to who you want to include as a shareholder. And again, more isn't always better, right? You just want to make sure that you have the appropriate shareholders. And if you've been incorporated already and you want to add family members, you realize that you didn't set it up, the way you want to for your current situation, you do need to do a tax reorganization to add them properly and not trigger any taxes. If you have a corporation and you simply add shareholders, again, that transfer of value does trigger tax for you, so not a good thing. And again, I would expect that most of you, there's probably quite a range in terms of who you have included as a shareholder of your corporation. And in general, it's a really good exercise to revisit whether you have appropriate shareholders in place, because everyone's situations change, and with that, plans should change with that. And if you have a corporation, remember that, as much as we're talking about tax planning for a sale, there is a lot of tax planning you can do on a regular basis. So, make sure you speak to your accountants to manage your family's taxes. Eric alluded to in the beginning that the budget's coming out and it's coming out on April 7th. So I would assume after April 7th, there's probably going to be more changes, that will impact you. Hopefully not a ton, but they generally aren't positive changes. So we'll see. Now, when you are selling your practice, there are very generally 2 ways of doing it, or a combination of those 2 things. So you either, do it through an asset sale or a share sale. And on an asset sale, what this is that, you as a seller sell specific assets of your practice. So, you would lay out the equipment, leasehold supplies, furniture, equipment, goodwill, etc. And you break that down line by line in the purchase and sale agreement. And generally, a buyer prefers an asset sale because there are no hidden liabilities. They're buying very specific things. And the biggest advantage to the buyer is that the purchase price is then allocated out to those specific assets, which essentially means that they have a large balance that they can write off for tax purposes. So they actually save taxes that way. The other option is the share sale, and you as a seller generally would want to do a share sale, and you would need to have a professional corporation and sell your shares in that corporation. The buyer, is then buying the shares and therefore everything inside the corporation. And again, why a seller prefers selling shares of a corporation is, first of all, only 50% of the gain is taxable. So instead of an almost 54% tax rate personally, in Ontario, it brings that tax down to 27%, which is already significant. Now, on top of that, if the corporation meets certain rules, which we'll go over, you might also be able to take advantage of the capital gains exemption, which we keep referencing. And in 2021, that capital gains exemption was $892,000, and it's a lifetime exemption. In 2022, that limit has increased to $913,000. So it gets indexed every year, so it'll keep growing. And that number, that capital gains exemption, translates to about $240,000 in tax savings per shareholder. So if you own the appropriate shares, that can compound to quite a bit and keep a lot more in your pocket after you sell your practice. And again, we talked about having the appropriate shares, and they have to be participating shares that we spoke about earlier. So just make sure when you're re-looking at your corporation, that if in fact you want to be able to use lots and lots of capital gains exemption, that everyone has the appropriate shares. There's only situations where we've been asked to do the tax planning because they're switching accountants just before a sale, and unfortunately the person that they thought had shares didn't have shares or didn't have the appropriate shares, and if you're looking to sell right away, those options can be quite limited. So be careful and make sure that you look at it on a regular basis, look at it again and again, and make sure your PC is structured properly. So a numerical example, let's say we have a practice that's worth $2 million, right? And the dentist is looking to sell the practice. And typically, again, the practice would then be split between different asset classes, right? So if on the right-hand side, you'll see that if you sold the practice through an asset sale, we would break that sale down into different assets. We didn't show all of the details here, but essentially in that case, if it was an asset sale, they would pay about $670,000 of tax personally. And that number actually changes depending on the asset allocation. So something to think about on the negotiation. If you're stuck with an asset sale, there's things you can do, even on an asset sale. Whereas we look at the left-hand side, if they were incorporated and were able to sell their shares, so having one capital gains exemption, and I'm assuming they meet all of the rules, right? So that allows them to use the capital gains exemption, they would only pay about $294,000 in tax. So again, with one shareholder, in this example, you can save $376,000 of tax on the sale. So super significant. Usually one shareholder is probably pretty easy to structure. And that can be done if you're unincorporated and would want to roll in the practice prior to a sale. So now let's look at what would happen if you were able to add more shareholders. So similar example where you have a $2 million practice, but again, this time we can actually have multiple shareholders and use their capital gains exemptions. So you can see from the breakdown that if you have two capital gains exemption, you would save $616,000 in tax. And if you had three capital gains exemptions, the full gain would then be sheltered, and you would save $670,000 in tax. So it grows quite quickly. So you can see that the capital gains exemption is really, really powerful, and you can net way more in your pocket after an actual sale by planning properly, right? And planning ahead of time. So as a side note, because a lot of people forget about this, whenever we talk about a tax-free sale, we mean it as for income tax purposes. So for your cash flow, we always break it down for our sellers that if you're using your capital gains exemption, what will likely happen is when you file your personal tax return, you'll likely pay something called the alternative minimum tax, or AMT. It is a refundable minimum tax. So over the next 7 years, as you earn money, you'll get that tax back, but there's that initial bit of cash flow when you sell your practice. But again, it's refundable, so that's the expectation that we can plan around it. But there's a bit of a cash flow difference in the beginning. Now, I kept referencing rules that your corporation needed to meet in order to use your capital gains exemption. So let's walk through some of them now. And I'll focus on the rules that have a 24-month test to it, because it requires, simply more time to implement. So If you're thinking about, for example, adding additional shareholders to your corporation so that you can use, the additional shareholders capital gains exemptions, you have to be mindful that they need to own their shares for at least 2 years prior to the sale. And practically, it might even take longer than that if we actually need to move value from you to the new shareholders because of a freeze. So just in case, we'd like to say that if you're planning on adding shareholders, the sooner you do it, the better. It just gives us so much more flexibility. There's a 50% test that also needs to be met 2 years before a sale, where at least 50% of the fair market value of the assets of the company are from an active business carried on in Canada. So that's a mouthful. But active assets essentially include receivables from your practice, the equipment, supplies, leaseholds, et cetera, whatever you need to operate your practice. Non-active assets or passive assets are essentially the excess assets that you don't need to run your practice. So you can only have 50% of the value be attributable to that. So for example, if your practice is worth 2 million, like our numerical one before, it was worth 2 million, then once you accumulate $2 million in passive assets, you're offside with this rule. So practically, to give you as much flexibility as possible in terms of the timing of when you sell your practice, you generally want to think about tax planning when your passive assets are approaching the same value as your practice. So when you have too much cash, stocks, et cetera, you want to start thinking about how to move that out tax effectively. And you can do that. There's lots and lots of options to do that. So when we talk about passive assets, what are we talking about? Typical ones that we see are either cash, so savings that you kept inside your corporation, or marketable securities. So if you're, investing in the market and putting it in, mutual fund stocks, bonds, et cetera. I should mention that, if you have another company that your corp is lending money to, so typically we have a lot of clients with, a side company where they're investing real estate, et cetera, that loan from your company to the other one is also considered passive. So be careful with that. And the nice thing about, cash, marketable securities, any of these loans receivables is that you have the ability to move it out of the corporation without triggering any tax. And obviously, it is a tax transaction and, requires quite a bit of paperwork, but it can be done, which is nice, right? And that's what you keep hearing as a purification. So it's purifying out these passive assets. Other assets, passive assets that are more complicated to move out, unfortunately, are, for example, real estate, right? Because it does trigger land transfer tax when you move it out. And, with real estate prices being what they are, also very expensive. And if you're in Toronto, double that, right? That can be really, really expensive if you're moving it out. Or if you have life insurance policies, which unfortunately we see a lot of, because if you have life insurance policies and you move it out from your corporation to anywhere else, it can be fully taxable. So depending on how long you've had this life insurance policy, that can be, the tax can be very, very, very expensive. So, it's important to understand what's inside your corporation and what you're buying with the extra cash, because again, certain things can be more difficult to move out later on. So take a good look at what's in, what's in there. And if you have real estate or life insurance, don't panic. There's usually some planning you can do if we do it early enough. So, I think it's just a matter of looking at options and seeing what's the best option for you. Now, when you do have passive assets inside the, corporation, there are a few ways of moving these assets out of the corp. So it could be as simple as taking out the money personally because you need the money. And with that choice, simply taking it out personally, there are a few options. The simple ones are dividends or salary, which generally people don't choose because it triggers up to 54% in tax personally. It's really, really expensive. But you can look at more creative solutions like paying out capital dividends, right? Or doing a reorganization to trigger tax at a lower rate. We'll see what happens after the budget because we're expecting some of these are going to get shut down, but let's see. Without going into these planning options in too much detail, I think the point is that if you need a lot of money personally, it's worthwhile to plan out how you're going to take it out with your accountant because there are likely options that might be more tax effective. It's just a matter of understanding what they are. And to the extent that you have practice debt outstanding, right, you can use the extra cash to pay down the debt or buy equipment or new equipment for the office or renovate it, et cetera. Just, be mindful that there's usually an opportunity cost when you're using cash versus debt. So, a business decision in terms of what makes sense for your practice. And finally, a common option that we use when our clients have saved substantial amounts in their corporation is, like we said before, doing a purification. It's really, really great way of transferring out the extra cash or investments into a company, another company, tax-free. And a purification is really a typical way of moving out funds. And again, it is complex because it's a full tax reorganization. Unfortunately, they changed the rules years ago that made it more complicated today than it was, say 10 years ago. And again, simply moving funds, like if you just transfer your money from your professional corporation to another, doesn't cut it. The reason, again, why a purification is really, really effective is because you don't have a limit in terms of the amount that you can move out. And again, you can usually transfer out the passive investments tax-free. So if you've invested in Tesla, say, and you earn a ton of money, that you wouldn't have to pay the capital gains tax in order to move it to another company. There are tax selections that we can do to prevent you from paying that tax, which is great. So again, the key here is that it is complicated and details very much matter. So make sure you do it right with the help of an accountant and a lawyer. And the reality is, as you start saving, and many of our practice owners do, you should have these conversations with your accountant on a regular basis. So they can kind of walk you through the various ways that you can manage your tax exposure responsibly. And again, understanding your options so that you know what you can do to plan for those taxes. So in summary, you should always plan ahead with the help of your accountant. Regular conversations around your corporate structure is really, really important, because your goals and your family structure changes, which means that, it could be an opportunity to update your corporate structure. And you should never be afraid to ask your accountant questions or just to have a conversation about it. I understand that some of these concepts might be complicated, but, in our experience, we know a lot about our clients, and, we are really, really happy to help, and we want to hear about what's happening in their lives and how we can, kind of contribute and make everything better. So, have those conversations. You should be comfortable to do that. And again, once you have a corporation, regular tax planning for your practice income is important because you can save taxes on an annual basis outside of a practice sale. And then before you buy real estate or life insurance policies, please make sure you speak to your accountant so that you're buying it in the right place. And that gives you the most flexibility for future planning. So don't, I know sometimes people make the decision to put everything in one corp because it saves money, but in the long run, that could be very, very painful. Keep track of your, corporate savings and passive investments relative to your practice value so that you can purify the corporation on a timely basis if necessary. And then finally, have a general timeline in place in terms of what you want to do with your practice, your career, et cetera, so that you can plan ahead. Those are the things that we typically talk to our clients about. And, it's really, really helpful to kind of frame everything so we can plan properly. So that's it. I've included my contact info here. I wonder why I didn't put my phone number, but I guess everyone interacts through email now. You want to call, you can send me an email.
There'll also be a good option as well for the poll, and we can get those connected right there for you.
That's it for me. I'm going to pass it to Bill.
Actually, Andrea, it's not it for you yet, because while you were talking, oddly, when you talk about tax, questions fly in. I don't know why, but I'm going to yield a little bit of my time to you, but so you don't have to look them up. Let me ask them. And I love this question because the person mistyped, and you'll get those of you with the keyboard, instead of using the D&D when saying, the question was, if you already have a PC and are a sole shareholder, can you still, they meant to say add, but they used the two keys to the left of the D, other shareholders of planning to sell in less than 5 years.
I love it. I've done that before too. So You can, if you're selling in less than 5 years, as long as it's not less than 2 years, right? So, if you're, 3-4 years, before then, you can do that. Having said that, like I referenced before, you just have to be careful. So, for example, if your practice, again, say the $2 million practice, right? And you are the sole shareholder, you freeze the company. That essentially means that the first $2 million of value belongs to you as the initial shareholder, and then you add all the new shareholders, right? So let's just say you actually did that 2 years ahead of time, right? Then 2 years later, let's just say the only person you added was your spouse, because that was the only person you felt comfortable with. If you didn't do any planning in like the interim, like in the 2 years until the sale, at the time of the sale, if the practice is still worth $2 million, the unfortunate thing is that $2 million goes to your special shares first. So you still only you haven't actually given any value to anybody else, I guess is the point. So, there's more to do, and, the more time you have, the more flexibility you have to kind of move that $2 million value from you to whoever else you might want to include. So,
what is the age requirement for children to be added as shareholders if the business has already been incorporated?
So you can add minor children, right, i.e. of any age, but they have to own it like in trust. So you just want to be careful whenever you do add minor children, and like you're giving them value shares, right? Because again, like it's money that belongs to them. So I know a lot of times when we're talking to our clients, they just don't really know, primarily who are they going to marry, let alone are they going to be responsible if they're currently like 5 years old. They seem so angelic at that time. Not really, not mine, but you just never really know. So you just really, really want to be careful when you are adding minor children. And then also you never know, like, I mean, they might use it for themselves when they grow up, right?
Can the CGE be used over multiple sales of practices if it is not used in one sale? Obviously, from somebody who does own or plans on owning more than one practice.
Very good, very good. You can, and that's why, as part of our due diligence, we always check that, right? We don't assume that you haven't used your exemption. Sometimes, if you've sold a smaller practice and you've eaten up some of it, then whatever's left over, you can still continue to use.
And can a PC buy and hold land with the intention of building a dental office? Try to answer that short, because you could go on for half an hour on that one, I think.
Yeah.
So I think this person's thinking about buying some land, eventually building a dental office there. And I think the question becomes, is it right to do that inside the PC? And what if the plans to build never go through? So.
Yeah. Well, I would not, because it's very restrictive, but I guess technically if you want to push the envelope, because I mean, you're allowed to own your practice building inside your PC. Again, we generally don't advise it, because again, you never know when you're about to sell your practice, whether you actually want to keep the real estate or, as an investment and rent it out to, the existing owners or not. But technically, I don't think, I mean, if you're putting that kind of investment into it, you probably don't want to, because what if, like, you build your practice, but there's room to do other things and you actually have other tenants, et cetera, then, it just messes it all up. So I wouldn't.
Okay. Good. Thank you. I'm sure there'll be more later. There was one more. There are a couple more, some of which you covered, but one is a very nice transition to me.
Awesome.
So let me start sharing my screen. We'll put my poll up. And I almost hit the leave key. That would have been a mistake.
Andrew and I would have done a great piece talking about valuations.
yeah, you would have had to do a soft shoot. So can you see my slides?
It is, if you did yep. Perfect.
Okay, so the transition question that was a really good one. It was, since, and by the way, the tier 3, answer the poll questions if you can. And Donya, I know you said you could email it to me, But if you email me the answers, they'll display on the screen. If you could unmute and just tell us the answers in 2 minutes, I'd just like a sense of who's in the audience.
Or you can share the poll results as well as we go through. We should be able
I'll
to
let you guys figure that out while I answer this question. So the question was, since buyers prefer asset sales, and they do, does it mean valuation can be higher? And I've got the accountant's on mute now, so I can express my own personal points of view. I think it's always a great shame when somebody sells in an asset sale. It's almost always a result of somebody having failed to structure themselves properly along the way because they weren't dealing with somebody like Andrea. Many of you know, and those of you who don't can see from the logo that has tier 3 now, I sold tier 3 just over a year ago. And because I got some great tax planning advice from MNP, I was able to sell it in a share sale and realized far more after tax than I otherwise would have. And there were a whole bunch of more complicated things above and beyond what Andrea covered. So just a plug to talk to a good accountant. But the reason it's a terrible shame when somebody sells in an asset sale is invariably more money goes to the government. Now, if you're a charitable person who believes sending money to Ottawa and Queen's Park is a good thing, you might want to consider an asset sale. But the tax benefit to the buyer of the asset sale is far, far less than the tax cost to the seller of selling assets. So properly structured, it should never happen. But to answer the question, there is a marginal increase in value if you're selling assets, but don't be thinking it's anything close to the 300 to 400 to 800,000 in savings that you get by selling shares. It's normally around 2 to 4% of the value of the practice. Because while the buyer can depreciate assets, at the corporate tax rate, which is a 12.2% in Ontario, they're not really getting a big tax savings from that, and it takes years. So, Andrea, have I said anything that's way offline, or you can just nod? Or okay, so if there's any way of telling me how many people are practice owners versus not, GPs versus, oh, here we go. So virtually everyone's a practice owner. Does it show us the 3 people who are tuned in as not practice owners? You're very smart. Find out what the sellers are going to find out. We've got 3 specialists, so I'll try to talk about where things are different for you. Can we scroll down on the last one? 5 years. Most people are 5 years or more away from selling. Or can we scroll down, somebody?
You've got, that's on yours. It's
oh, is it on mine? Oh, okay.
40% are 5 years or less.
Yeah.
27% are 6 to 10 years away, and 33% are beyond 10 years.
Thank you very much.
You're pretty equal, third, a third, a third.
Yeah, and there was one person who asked if I'm selling in less than 5 years, am I going to get anything out of this? I answered it in the poll, in the chat. Yeah, absolutely. I'm sure you've already heard enough from Eric and Andrea to make you confident you're investing your time wisely. Okay, so let me jump into things here. So, whether you're one of those people selling now or in the future, we all know that, and Eric talked about the passion we have for doing this. This is not only going to be one of the biggest financial decisions you're ever going to make. It is, and I've watched my wife sell her practice. I sold my practice. It's one of the biggest lifestyle decisions you're ever going to make. And beyond just the sort of the personal aspect of it, most of us care a great deal about what's going to happen to our staff, in your case, your patients, in my case, it was our clients. And you're going to be entertaining lots of thoughts about how you wind down your ownership career, which may not be the same timeline as winding down your career as a dentist. My wife sold her practice because she hated running her practice. She didn't want to retire, but she figured, oh, I'll give it 3 years. After she freed herself from the ownership, that 3 years became 7. Simply because she rediscovered a love of dentistry that she'd lost. So no matter which of those things matter most to you, and they probably all matter to some degree, it is really very important to plan this properly. And so thank you for investing your time tonight to start down that path. And while ideally beginning 5 to 10 years in advance is fantastic, because if you've got a lease that you just renewed 4 months ago and it goes for 5 or 10 years, Eric can't help you as much as he can if that renewal's coming up. Andrea's talked a lot about the timelines for what she can do, and the same goes for what we can do in terms of providing you with advice on how to build the value of your practice and make it more attractive. I'm going to cover that from a top line standpoint today. But like every lease is different and requires expert review, every practice is different, and every person's tax situation is, right, Andrea? So I'm going to cover 3 things. Number one question I continue to get is, Bill, if you still have the beard on, we're still in the pandemic, right? And I say, yeah. And how's it impacting the sale of practices? And how strong is the market, and is it a good time to sell? And then I want to talk about 7 keys. And if you stick around until the end, I'll give you an 8th bonus key to success that you may want to start thinking about for your practice. So what's going on with practices during COVID? We're appraising, I think it's close to 300 practices a year now. And I know from talking to so many clients that most of your issue is you see one practice, yours. And to the extent you hear from colleagues and friends, you hear about the problems more than the big wins. So not everybody has a real sense. The majority of practices now, if you're looking at revenue, are back close to or ahead of their pre-pandemic levels. But there's an interesting split in those revenues. Dental revenue is often running ahead of where it traditionally had been, as practices get caught up on not only that 3 months of deferred treatment from when you were closed, but a lot of people who are reticent to come into the office over the last 2 years now, basically. So just because your dental revenue isn't up, or is up, doesn't mean it's going to stay up. In the short run, that's been offsetting ongoing challenges people are having in hygiene. I would still say that more than half of the practices we're appraising don't have their hygiene revenue all the way back yet, although it's coming. And this is an issue for patients' oral health as well as your practice value, because hygiene revenue is far more important to the value of your practice than dental revenue is. Hygiene is far more sustainable. It doesn't change when the ownership of the practice changes. And the moment you say a dentist's time is worth 40%, hygiene revenue is more profitable too. So buyers want to see a strong hygiene program. What are the challenges there right now? Well, fallow times in Ontario are still reducing productivity. We've got a shortage of hygienists. That's driven in part by people leaving the profession, but also simply by those fallow times, which means to do the same amount of hygiene as you used to do, you need about 10% more hygiene hours, simply because you lose about that to fallow times, even if you're down to sort of a 10-minute break between patients. Wages are escalating, and the impact of all of this on your revenue, your earnings, and the oral health of your patients is critically important. So, if you take one thing away from this presentation, go into the office tomorrow, ask the front desk for a list of all of the patients that have not been in for a hygiene appointment in the last year, and get them to work on getting them in. One thing, I am not always entirely complimentary about what the ODA does, but you all should call up your ODA rep and thank them for what they've done for you in terms of the fee guide. We've had 2 back-to-back years of more than a 4% fee guide increase. So to the extent that the pandemic's hurt some of your costs through increased wages, increased supply costs, they've had your back covered. So profitability continues to be quite strong in most practices. So is it now a good time to sell in the middle of the pandemic? Well, from the beginning of the pandemic, I'm using the Tom Cruise slide, the show me the money slide from the Jerry Maguire movie. If you can show buyers the money, the market's as strong as it ever has been. And it's always been true when selling your practice that you're really only as good as your last 12 months. And if you're going, oh, well, my last 12 months suck. 6 months from now, we can look at a valuation looking at annualized 6-month numbers sometimes. But it's really important to get that revenue back. If your business is back to pre-pandemic levels, so is your selling price, if not higher. If not, there is still a strong market for your practice, no doubt about it. But it's not going to be quite as strong as if your revenue was back. There are as many or more individual buyers in the marketplace today as there used to be. Corporate buyers are paying more than they ever have, and that is also helping to pull up what individual owners are going to have to pay and what what multi-site owners will pay. It's beyond the scope of this discussion to talk about Ebitda multiples and things, but it's as good a time as ever to sell your practice. So let's talk about some of the things that you should be thinking about. The first one, and this is one of the biggest surprises I find people have when they first talk to me. And it's, you need to know what you're going to be selling. You may be selling your practice, you may be selling the building, or you may be selling your patient base only. And that, where you are on that is going to be a major consideration in terms of what you do with respect to your lease. And it's got a bunch of planning implications as well. So the quick rule of thumb I've got is if you have more than and it's on your screen in front of you, if you've got more than 1,000 patients coming to your practice annually, and you've got more than 80 new patients a year, that's enough to offset normal attrition, then you're probably going to be selling the practice. But if you've got less than 1,000 annual patients, or you've got 1,000, but you've only got 40 new patients a year, and next year you're going to have 960, then you're trending more towards your patient base will be more valuable than your practice. Unless, of course, you launch a successful marketing plan and drive that patient base up. So understanding this one's hugely important, because obviously if you're selling the patient base, you don't want to get into a 4-year or a 5-year or a 10-year lease, because somebody's got to pay the landlord even once you've sold the patients. And patients can be quite valuable. It's not uncommon for us to have a situation where the patients are as valuable as the practice. If you've got, and people were asking about buildings, if you own a building in Toronto, that building could well be worth $2 million, $3 million bucks, depending upon size and location. If your practice is only worth 800,000, you can't let the real estate, the practice tail wag the real estate dog, because you should be optimizing the sale of the real estate. And maybe the way to do that is sell the patient. So it's important to know where you're at on that one. Next two, basically everything Eric and Andrea said are the most successful things. The biggest mistakes I see are people who do not have adequate tenancy certainty. Ideally, you want 12 years. So a 5-year lease with 2 5-year renewals, or a 10-year lease with a 5-year renewal, and you want to be at the front end of that, because if you don't, purchasers are going to have to factor in the cost of relocating the practice when that lease runs out. So last year we had a Mississauga client whose practice sold for $300,000 less than it otherwise would have, because they had a demolition clause that was kicking in 3 years. We had a client with a demolition clauses require a pretty significant commitment from a landlord. But the new clause is demolition or renovation, right, Eric? Substantial renovation. How big a commitment does substantial renovation take from a landlord, Eric? You know,
yeah, in the eye of the beholder, could be very little, could be nothing really.
Yeah, I'm sure there's a legal definition somewhere of substantial renovation, right? There's not. And we had somebody whose practice literally sold for 120 grand less than it would have because it had one of those clauses. And so, you know, everything Eric said is critically important. If you have a demo, relo, or reno clause in your lease and somebody as skilled as Eric and his team can't get it out, you know, don't go jumping out a window. You've got to start thinking of its cost of doing business. And more and more GTA area practices have these. And if you don't have one now, the landlord may stick one in later. And if they do, it's a cost of doing business like many of the other ones. It is why owning your own building can increase the value of your practice, because most buyers would rather not have a landlord. And I just cry when people have not structured their affairs to get the capital gains exemption. We had a recent sale where sadly the dentist had passed away. They weren't incorporated. And there's a general principle that it was a male, dead men can't incorporate. But then we have other people who have to sell for various reasons and have too much cash. So what Eric and Andrea said are the most important things I can tell you too. Now, what else can you do to build the value of your sale? Build your hygiene program. I've already said hygiene is more sustainable and it is more valued by buyers. And we see massive variation in hygiene programs. That slide in front of you is some analysis we do in every single practice we appraise that shows the hygiene billings per hygiene patient per year. And if your screen resolution is really good, there are a bunch of green vertical lines or bars there that show the last 300 odd practices we've appraised. The average is around $270. But you know, the extremes are from about 150 up to over 500. I've marked two there. One sort of bottom decile at $200 per patient per year, one at the upper decile at 350. If you've got about 1,000 patients coming for hygiene, that $150 per patient difference is $150,000 in revenue, which could increase the value of your practice easily by $300,000 to $400,000. And the thing I love about hygiene is that moving from that red line to the blue line is generally entirely consistent with your patient's oral health. And when we do appraisals, we do a whole lot more benchmarking than this. We look at the revenue per patient per year, which is this, but then we break it down into what you're billing per appointment, how many real appointments per year patients have. Everyone says, oh, Bill, I've got everyone on 6-month recall frequency, many people on 3 or 4. Invariably, they're surprised when we show them what's actually happening. So build your hygiene program, folks. You can do it out of economic motivation, but frankly, you're doing it to help your patient's oral health. Increase your patient base to the extent you can. You should be tracking the total number of patients you've got, the hygiene patients and new patients. This is a standard part of our analysis. And it shows something very interesting that is pretty typical right now. You can see the first set of numbers are from 2019. There were 1,498 total patients, roughly 1,400 hygiene patients, dropped off big time in 2020, but you can see this practice has not bounced all the way back in 2021. And their hygiene program is still way down. So you want to be looking carefully at your patient base. In the long run, the size and nature of your patient base will determine the future billings and earnings, and therefore the value. I've talked about building your hygiene program because that's so consistent with your patient's oral health. Look for other ways that you are comfortable with to increase earnings. I am not here to tell you to diagnose and treat based upon your practice value. Quite the contrary. I'm married to a dentist who is highly principled. But there are things you can do that are of real benefit to your patients that will increase the value of your practice. If your patient base is large enough, consider insourcing some specialty work. Have somebody come in to do implants rather than referring the patients out. Consider clear aligners. I used to say Invisalign, but once I sold to Henry Schein, I'm contractually committed to use the term clear aligner because they have a reveal product that I'm told is much better. So consider introducing clear aligners, whichever brand you prefer. And also, if you've got a lab billings of 6 to 100,000 or more, absolutely consider in-house crown milling. That technology has changed massively over the last 10 years, if you've heard bad old stories about it. And if you've got a $100,000 annual lab bill, and you're able to do, say, 70% of that in-house, that could easily increase the value of your practice $300,000 to $500,000 simply by insourcing that, what you're referring out and making no money on. These kind of things take time, obviously, which is why all of you that are more than 5 years away have time to get it done. And get contracts in place. Those of you who have associates, if they do not have a contract, and if you haven't had it reviewed by a good employment lawyer or somebody like us recently, you may be taking major risk with your practice if they don't have a binding contract. And all the time we run into dentists who go, well, Bill, I trust my associate. They would never do anything to hurt me. We're best friends as well as business, involved in business. That's all well and good, but the number of times that owner's been surprised when the associate suddenly feels they're entitled to some of the proceeds of the sale because they helped build the practice, or when they announce that they're setting up down the road, it will kill the value of your practice. Staff contracts are highly desirable and will reduce your sale after, or your liability after the sale. In the interest of time, I won't get into that unless we've got questions on it. And I promised you a 8th bonus question or key. But before I reveal that, ask yourself this question. Do you know what % of your eventual retirement assets your practice will represent? So if you figure, oh, I need to have 5 million to retire, do you know what % your practice will represent? Because if you don't, you might want to think about getting a valuation done, because you may already be where you need to be, or you may have further to go than you realize. The number one problem I've already said leases and capital gains were the number one problems, right? I can't, the number 3 problem I see is people who heard somebody once say, oh, well, practices are selling for 140% of gross revenue or 200% of gross revenue. And somehow somebody figured, oh, okay, that's what my practice is worth. The truth of the matter is practices don't sell for 140% of gross revenue or 200% of gross revenue. They sell for somewhere between 85% to 225%. And that, don't do the average and figure, okay, well, I'll be right in the middle, because it's not a steep, narrow standard or bell curve. It's very flat. And it's because revenue doesn't drive your value, earnings do, and earnings as a % of revenue vary so much. But if you get a valuation done, you'll know where you're starting from. And so long as you're working with the right valuation firm, and there are a number of good ones out there. This isn't just to say us. You'll have a really good discussion about where the levers are to move and increase your practice value. So if you've got, if you're planning on selling right away, you need a valuation anyways, but doing it well in advance gives us a chance to go through all of the things we've talked about and then more, and help you chart a path to get you where you want to go. So that is it for my section. And I think I hand it back to Eric, unless we've had questions come in that I should answer.
We have had a few, a bunch come through, and then also we've got some pre-webinar questions. Before we jump into the Q&A, here's our poll. And again, a lot of you have reached out or sent some individual notes, or I've seen our info at email box fill up. But just to make it easy for everybody, again, if there's some requests, if you're offended that Andrea didn't put her phone number up, here's the easiest way, here's the easiest way to do it. Again, if you have any concerns about your specific lease, before we jump into Q&As, quick yes for number one. Again, if you've got questions for Andrea or an MNP representative, click yes for number two. And number three, if you have not had the itch to say, I wonder how much my practice is actually worth, right? Click yes for number three, and we'll make sure that, again, the teams coordinate a quick call with you as quickly as possible. Yes, one of the questions that did come in, Bill, is a question now from a specialist, an orthodontist.
Yeah.
Is there a guiding multiple for selling an orthodontics practice, i.e. percentage of gross revenue or multiple of Ebitda? Right, Bill, I've heard 5 times, I've heard 10 times Ebitda. What the heck is, what's in it? Let's say both for a GP as well as, and I know you just sort of touched on it, but all for the specialists as well. There's a lot more that just filled out the poll, but Bill, what can you share on that?
Right, so let's begin by Ebitda, for those of you who do not know, is an acronym for earnings before interest, taxes, depreciation, and amortization. Those last two are redundant. It's always bugged me since like I was a business school student. But the key thing to understand though is it's after paying you, the dentist, to have been the dentist in the practice. And Ebitda multiples vary from, it depends a lot on the type of specialty and whether there's a good transition plan in place. We have sold specialty practices for 4, 5, 6 times earnings multiples. And if it's a group practice or there's a high potential for revenue to be sustainable, given the nature of the transition plan, they can go for higher than that. Some of the corporate buyers, we've seen cases where they're pushing almost double-digit multiples, but that's not for a standalone single practice. You know, when you think about it, your earnings on a backward-looking basis, which is what Ebitda is, don't amount to a hill of beans in terms of what the purchaser really cares about. They want to know what earnings are going to be in the future. But you know, the big orthodontic consolidators have been working at 5 times. Some of the bigger, more broad-based consolidation firms have been higher than that.
So one that's for us both, and then we'll go to some of the pre-questions we've had, and I see almost all are still with us. So again, if this is, again, we'll keep it interactive, lots of extra questions, and we'll keep Andrea from going to bed because she's already got, you know, at least another 12 more filings to complete tonight. With that being said, so the question is here, if you only have 4 to 5 years left on your current lease, how does this impact the sale of your practice? So Bill, let's, I know you know what I'm going to say here, but from your perspective, a doctor reaches out to you tomorrow to say, Bill, I've only got 4 to 5 years left, and as far as I can tell, my landlord's not willing to give me any more term. How is this going to impact the buyer's ability to get a loan? And what guidance can you give to a doctor that is, again, let's say, started at 20 years ago and is now coming to the end of that 20-year term or 10-year term with 2 5-year options?
Yeah, my first comment to them is going to be call Eric, because you've got some work to do with your landlord. If you only have 3 or 4 years left and the landlord is not willing to extend that, what the purchaser has to do is factor in the cost of relocating your practice 3 or 4 years from It's going to significantly reduce the desirability of the practice. And if they've got to plan in moving a 1,500 square foot practice at $300 a square foot, and you'd quoted some higher numbers, that's a conservative number, they're going to say, well, yeah, I love your practice. I'd love to buy it, but it's going to cost me $450,000 to move it in 4 years. So my first advice would be see what you can get from the landlord. Second thing, the first thing would be, let's figure out whether you should be selling the practice of the patients in the first place. If the patient base has trickled down enough, maybe this isn't such a bad thing. But assuming it's a saleable practice, then it's see what Eric can do with your landlord, and if he can't, we can still sell it. It's just not going to sell for as much. What would your thoughts be?
Yeah, no, Bill, we're very much aligned. It's risk. And in many cases, the buyer will not get a loan because the underwriters want to see that continuity and predictability. They're not going to give a young associate $1 million loan or $1.5 million loan when there's only a couple of years left on the lease, especially now that they're spreading it out over 12 years, which is unbelievable, really. But from that perspective, yeah, part of the approach is figure it out early. In many cases, don't forget, the landlord just sees a dollar sign on your forehead. They care about term and rent. So if there's ways of turning the table, so a lot of times we're drafting a very aggressive 10-year term with 2 5-year options. We're looking at now giving that predictability and continuity on behalf of your future buyer. And or if there is, let's say there is a redevelopment or a relocation risk, then quite frankly, don't you want to figure that out now? So part of our approach would be is, well, let's draft a pretty aggressive letter of intent for a 10-year term, even though you might be midterm, but let's at least see if there's a full court press no, or our team's able to find out that actually it is on the redevelopment plan for 2027. Again, if the ship is going down, do you want to be the last mouse out type of thing? Or would you rather be the first person to find the most desirable location now and be able to plan an early exit on your terms versus the second you reach out to Bill does the full analysis, suddenly then we're reaching out to the landlord. Then the landlord says, well, actually, no, we're not doing any further leases. And now we got a big problem. And now you're right, as Bill said, $250 per square foot discounted back per year. It's $250,000. When we fix that one clause, that's instantly gives Bill the ability to ask for an extra $250,000 for a 1,000 square foot practice. That is major money, purely because now you're giving that, that continuity of revenue. You're giving that term, you're giving that new doctor the keys and that rock solid foundation that they can continue to work there without the fear of, oh my God, now I got to go back to the bank and ask for another $300,000 to move across the street.
Yeah, we've got a couple of your clients right now where they're looking at relocating. I did a consult with them, and that was exactly the advice. But then the other key thing is make sure you're dealing with somebody who knows their way around these issues. Because you will get the knee-jerk reaction that Eric described, which is, well, we've got to amortize the loan over 4 years. And if we're normally over 12, the math on that is you're paying 66% less for the practice because you can't borrow anymore. We've got several bankers we work with who we can show a 12-year forecast and say, okay, look, they're going to pay this much for the practice. They're going to need a $400,000 loan in year 4. And they can still repay everything over 12 years. But so we've been able to get 12-year amortizations on very short-term tenancy situations, but only because we had to work pretty carefully with the bank. And I wouldn't count on that all the time.
So that's, yeah, certainly some core components. So let's talk about the doctors that are now saying, you know what, Bill, I'm done. I was used to wet finger dentistry, actual wet finger pre-latex, as my godfather, others back in the early 80s, late 70s, and now it's time. I'm out within the next 6 to a year and a half, let's say. So within the period of 6 months to a year and a half from now to 2 years. What's your biggest advice, Andrea? Let's start with you. To someone that is that does have a professional corporation, but is looking to get out ASAP, ideally within the next 6 months or in that relevant time.
Oh my goodness. So you don't have a lot of time. So I would suggest that you really assemble the team, like as a first starting point that you want to work with. I'm going to stick to tax, right? Because I'm sure there's tons and tons of other things that you're going to have to worry about that, Eric and Bill would be great at walking you through. But from a tax perspective, you really want to, sit down with an accountant and take a look at what the share structure is for your corporation. Take a look at what's, your financial statement, the most recent one, in terms of what's sitting on your balance sheet. So what are the assets that are in there? Take a look at your individual situation. I feel like a lot of people miss that. Like, they might meet all the rules inside a corporation, but then individually, I actually have one right now where there's tax shelters that they've purchased way back. And, in order to get rid of those loss balances, it's going to take quite a while. So you can't magically do that. So I think it's really sitting down and figuring out what you're getting into and what you can do if you were to sell your practice, what the tax consequence might be, so that you can decide, to Bill's point about, what your practice is worth as a percentage or whatever, as a portion of your overall retirement asset. I think that's important, because if after the tax bill, it's now either less than what you wanted or really, really close, and you might want to extend it out a bit, then I think just for your own planning purposes is really, really important to think about.
And then part two, then, Andrea, let's say you're 10 years out. Let's say you own multiple practices and a few pieces of real estate, let it be a condo or otherwise, that the practice is within. What guidance would you give to someone that is, 10 years out, that has a lot more malleability and is contemplating growth and scaling from here?
Yeah, so 10 years out, you can do a lot, which is nice. But I think again, you want to get the lay of the land in terms of what your structure currently looks like, and to the extent that we can make some changes structurally to get more in terms of tax savings or flexibility, et cetera. I think it's really, really important to understand what each of those options are, what the benefits are, with each of those options, what the cost is, because it's literally a cost benefit analysis. Because just because it can be done doesn't mean you should do it, because sometimes the cost is honestly just more expensive than the benefit. So walking through each of those options, and then if you were to choose one or a few of them, then it's figuring out, okay, what is the plan? When do you actually want to go through each of those planning options? Because it doesn't necessarily have to be right away, right? But having a plan in place so that you get what you need done over a period of time because it makes sense for you. And again, those plans can be drastically different from person to person because of your practice situation, your personal situation, your family situation. So it's really important to understand what is happening so that, we can look at options and plan accordingly.
Bill, same question, 10 years versus 2 years.
Yeah, I begin with right where Andrea led off there, which is, everyone's situation's different. If you want to sell within the next 2 years, it is really important to sit down with somebody soon to talk about what your objectives are. Not all of you will have the same objectives. Talk to somebody who does this for a living. You wouldn't do a 4-canal endo retreat on yourself if you're having a problem, because you don't do that all the time. So talk to somebody who does this for a living, because it never fails to amaze me how when we sit down with the client and find out what they really want, that there are often ways of getting there. The great news for all of you is that there are still far more buyers than sellers. It is still a seller's market. And if you've got 2 years, you want to chart the path to get as much of what you want as possible. And that'll vary from each of you. Some it'll just be cash, others it'll be who the person is you're selling to, others it'll be staying on, etc. And just like Andrea said, if you've got 10 years, there's all kinds of stuff we can do. And we can help you navigate a path, you'll know where you're starting from, what the practice is worth today. And I would say I've got to start actually double checking this, because I'm a tend to be a very data-based guy, and I haven't done this, but I would say the average appraisal we present identifies somewhere between $150,000 to $250,000 in opportunity for you to increase the value of your practice. And you're not going to do all of that stuff, but at least if you know where you stand, and what options you've got on 5 and 10 year time horizons, you've got a huge opportunity. We had a client in Eastern Ontario who virtually doubled the value of their practice, and the starting value was between $2 and $3 million, simply by taking steps over a 4 to 5 year period to do the basic stuff. So it's worth a bit of your time.
Indeed, and to build on that as well. So even from a leasing perspective, let's say you are 10 years out. Think about it from your buyer side. So you're 10 years out. Ideally, a 10-year term with 2 5-year transferable options can ensure that when you are to sell, or if, as my godfather or otherwise took a bad divot, ended up tearing his rotator cuff, he could never practice again. By being able to plan out as much as you can in advance is key. So having those 2 5-year options and 20 years worth of predictability of term is fantastic. And let's say you're 2 years out from selling. Well, again, term is great, and lots of it is great. So options, even if it's you're risk averse and just a 5-year term with 2 or 3 or maybe even 4 5-year options that are transferable to your buyer, gives a beautiful perspective that Bill can lay out a beautiful, yellow brick road for the doctor to ensure that, yes, we're assigning this lease. It's been professionally structured. It's a smooth assignment that minimizes the landlord control or ability to make life difficult, if not miserable, through the transition of the sale of practice, and to make sure that the buyer can pick up right where you left off. And most importantly, minimizing your liability and continuing liability post-sale is a very reasonable ask, but it's much more likely and beneficial 10 years prior when there's lots of runway before your eventual sale. Good. I know there was a few other quick questions that dribbled in. I see almost all are still with us, but from that perspective, feel free if there's any last few questions from Q&A. If not, we'll let Andrea get back to all her evening filings this evening. Bill, I think a question that came through on both sides is a health spending account for the employees, perhaps from a valuation or perhaps any sort of tax components there. Bill, you want to touch on that from a health spending account?
Sure, and thank you for your feedback, the person who just gave me feedback. It's wonderful, this digital world. My watch is telling me. So healthcare spending accounts, I'm by no means an expert, but let me approach this from the standpoint of, you all know that your staff are the second most important value, or second most valuable asset in your practice after the patients. And if you feel that a staff healthcare spending account, and Andrea, I'll throw it to you in case there are any tax side to this, but if you feel that will help you retain staff, it is a war out there for staff. You all know this. If you have to go out and find new employees right now, you're paying far more than you were 2 years ago. And that is going to hurt the value of your practice because your earnings drop a bit. But great employees can more than offset that by helping build the business. So if you think a healthcare spending account, buyers won't fundamentally care one way or the other because it's something they could introduce themselves if they believe in it. But they will care about your last 3 years of business results. And having a stable staff base is more likely to get those than not. Andre, any tips from you on that from your point of view?
I think that's a very good answer. If your health spending account was actually for all of your employees, I think what we typically find is that your health spending account is more for the owner that is employed by the corporation. So I would assume if that was the case, that would get shut down before it would, go to the buyer. But I mean, Bill, I think that's a great point. Like that, I mean, we all have, there's a shortage of good people that we want as part of our team, like whether it's dental, like your company, like ours in accounting.
It is. You can't get accountants. We can't get analysts.
My goodness.
Eric's well staffed. You can trust Eric to have great staff, but but Andrea and I, we're struggling to get all the people we want.
We struggle. Yeah. I mean, it's so, and I, from a lot of our dental clients, they're complaining about the same thing. Like it's hard. So, if it's a retention tool, great. Yeah, I would assume that you can't just shut it down if it was a retention tool.
Yeah, and actually, the question was for our employees. It wasn't somebody just looking to do it from their self and their family.
Awesome.
Indeed. Here's a great question that I don't think we've ever had before. So it's going to cause a bit of a cage match here. So this might be a good one to end on. Dr. R has asked, if planning to sell a practice in 10 years, who do you see first to plan it? Eric, Bill, or Andrea? So Bill, why don't we give you the honors for this one? Because
it doesn't really matter, because I'm pretty sure that each of us will look at your situation and go, this is my lane. I can handle my lane, but the number of times I tell people, look, I know enough that I could be very dangerous on the tax or lease side, but I can spot problems. I'm going to send them to the expert for the solutions. So it doesn't really matter, is what I would say. Unless that's it. I don't know if you guys feel any differently.
Agreed. And plus 10 years, you have so much time. Even if you met one person a year, you're good.
True.
Yeah, and actually, if you're meeting one person a year, start with Eric, because the lease is the thing that's on 5 and 10 year time horizons. Andrea and I can work some magic on shorter time horizons, but having that lease in the right shape, that's really important.
Yeah, I would add, I appreciate that. The only caveat I would say is, if you're about to sign or have signed, just signed a 10-year term, then that goes fast. And your ability to make those changes, as Bill's shaking his head, right, is minimized. So yes, the having that structured well. But regardless, if you talk to Bill and the lease is a concern, right, we're through there, right? If you've got one corporation over your entire enterprise, a great time to talk to Andrea now to talk about, well, what does make sense? What do the next 5 to 10 years look like? And perhaps before you make your next investment or your next purchase, maybe then it makes sense to add a new corp, and what can be done now versus the future. So lots of ways that can be done. It really just, again, depends on your specific situation and what's up next. If you're about to open a new clinic, well, before you do that, probably a great opportunity to connect with Andrea to make sure that here's what I've done thus far. I've been bootstrapping it to get through it from point A to point B. And now what's next, right? What should I be doing now? What can I do to correct it? And is it worth correcting, or at what expense to make some corrections based on what would be ideal? Got it. Great. Okay, that is perfect. I know we've gone a little over for questions, but I truly cannot thank both of you enough. These are some of my favorite events for the entire year, especially Andrea. You have every piece of stress, and this is your Super Bowl. But so we really appreciate your time, especially this time of year. We truly can't thank you enough on behalf of all of us here at Cirrus. Andrea Chen, really appreciate it.
Yeah.
Bill and I, it's our Super Bowl / cottage event for Bill.
We're more level over the year, but this is I want Andrea to get back to work, because I've got some tax stuff at MNP right now, but Andrea's not handling it, so.
You want me to bug somebody for you, Bill?
yeah, exactly. Give Jeff Rohr a call. No. I am like the clients you hate that can't find things and get it in late, and so.
Takes forever. And the tax forms, everything's late. Poor accountants, right? The tax forms finally come out and due the next day. It's unbelievable what they do.
That's a great way to end. Everybody on the call, have mercy on your accountant right now.
Yes.
Accounting and tax has gotten dramatically more complicated over the last 2 years, going through the pandemic. And so just be kind to them, get your stuff in early and often, because I work with them enough, and I want them to have some time to deal with me on the stuff we need their help on, but selling practices. So it's self-interest, but no, be kind to your accountant. Yeah, you can treat your broker and your lease negotiator like crap, but be nice to your accountant.
Amen. Thank you so much, everybody. Again, we'll be in touch for those that do want the recording, and really appreciate everybody's time.
Yeah.
Thanks very much.
Eric.
Thanks, everybody.